The reverse mortgage remains a niche product. A recent report cites potential reasons and solutions. Hello and welcome back. Despite that more Americans are retiring without sufficient savings to fund their non-working years, reverse mortgage loans, at least federally insured ones, remain a niche product, one whose acceptance has shrunk considerably in recent years. That conundrum is addressed in a recent paper that was released by the Brookings Institution. It's entitled "The Unfulfilled Promise of Reverse Mortgages: Can a Better Market Improve Retirement Security?" Now, it's somewhat ironic when you consider the increasing debt that's held by older Americans, the near complete disappearance of pensions in the private sector, and also the increasing longevity of the American today. You would conclude that this should be the golden age for reverse mortgages, but it is not. The authors of the paper from the Economic Studies at the Brookings Institution made their case on why the home equity conversion mortgage, or the federally insured reverse mortgage loan, is not widely accepted, and how the HECM can move from being merely a niche product to one that has widespread acceptance. Now, for those of you not inclined to read the full report, here's our brief summary. Now, first are the obstacles that could be contributing to what the authors call quote-unquote low uptake rate. Higher upfront fees than a traditional mortgage, the complexity of the HECM loan and its options, and the warnings on the risks of foreclosure. Now, it's somewhat odd about foreclosure that the federally insured reverse mortgage is the only loan that mandates a warning of a potential foreclosure when you have a non-payment of property taxes or insurance, when that same risk does exist in traditional mortgage loans. However, a case for such a warning could be made, as over 9% of HECM borrowers were actually in default on their property charges in 2012. Another factor may be that many retirees see their home's untouched equity as a hedge or a safety against financial shocks, such as healthcare emergencies or family needs. Now, one major factor that is not addressed at all in the report is the absence of trusted banks whose brick and mortar presence and their national reputation helped reassure potential borrowers who were considering the loan. So let's look back at the number of HECMs major banks did produce. In fiscal year 2009, Wells Fargo originated over 18,000 HECMs, and Bank of America had over 8,600 endorsements. In fiscal year 2012, after the two largest HECM originators had exited, MetLife Bank and one reverse mortgage produced a combined 15,000 endorsements together. Total HECM endorsement totals dropped from over 50% from the years 2009 with over 114,000 to the year 2012 with over 54,000. The fallout of trusted brand name brick and mortar banks cannot be overstated. Now back to the report. Negative media reports of widespread defaults in large cities such as Philadelphia, Chicago, and Baltimore, like the USA Today expose, could stoke fears of older homeowners who could see the loan as a means of banks to seize the property and the equity and then foreclose on seniors. But then comes the confusion that may be created with HUD's classification of foreclosures that are reported. The GAO, or the Government Accountability Office, reported in 2019 that 18% of reverse mortgages did end in foreclosure. However, 75% of those so-called foreclosures were actually the natural end or the termination of the loan when the last borrower passed away or no longer remained in the property. The other 25% were actually due to the non-payment of property charges. A big difference. The government's attempt to rein in the reverse mortgage program in the wake of mounting losses from the housing crash may also be subduing demand for the loan. The paper does cite the reductions in principal limit factors in 2013, the financial assessment as part of qualifying, and upfront closing costs, all contributing to low acceptance. Now, how could the HECM be moved from a niche product to a more mainstream loan, helping increase its acceptance? Well, the authors have some ideas on that. They suggest three alternative reverse mortgage designs. First, a low 0.5% upfront insurance premium they project to increase demand by 50%. Second, a recourse design, I'm not sure what that is, with a 300% increase in demand. And third, a zero upfront cost loan to increase demand fourfold. The authors do conclude their findings stating this: our view of the reverse mortgage market is that it shows potential for growth and could be substantially aided by the thoughtful reforms listed above and described in the companion papers. In particular, reforms that mitigate foreclosure risk would likely boost both the supply of and the demand for reverse mortgages, potentially making the products cheaper in the process. Now, what are your thoughts on the true reasons or the root causes of reverse mortgages remaining a niche product despite the growing need to fund retirement? Is it the factors that are named in this report, or the exit of trusted banks? You can leave your thoughts in the comment section below. If you would please share this video with others using the social media links found on this page. And you can subscribe to us on YouTube. Yes, we're there now as well. You can do that by smashing the subscribe button. Thanks again for watching, and be sure to return next week for more reverse mortgage news and analysis here at HECM World.